Talking about rules, over the past 2 weeks, we've seen wild swings in the markets with the Dow moving on average 450 points per day. And there's a growing chorus of investors blaming the machines. In a recent investor letter obtained by the FT, do we have to give it the FT credit? Our guest host, Lee Cooperman, said market fundamentals like China's currency moves and uncertainty over Fed rate hikes, quote, cannot fully explain the magnitude and velocity of the decline in equity markets last month. He just said that right here at the table. So I figured this.
Well, the question, if with your permission, I'd ask Joe, is technological innovation overwhelming markets and having a negative effect in excess of the benefits?
Let me just tell everybody, Joe Saluzzi is here, we should say, from Themis Trading. I know he's a friend of yours.
Yeah, I would say
he's
no.
a good man.
To that, but you didn't mean me.
Well, listen, I think Lee's is on here, spot on when it comes to a liquidity vacuum that existed, particularly on August 24th. Why did the market move 1,000 points? Why did ETFs go down 50% in a matter of minutes? You had a liquidity vacuum, and you had a liquidity vacuum caused by a market structure failure. We have a market design problem in the equity markets. We've catered to the high-speed traders over many, many years. Now, this is not overnight. So what's happened is the traditional liquidity providers are gone, and there's no limit orders anymore. You don't have a diversity of the book. You have a fragmented mess of the 11 stock exchanges and over 40 dark pools, which try to connect, but in times of stress, they don't, and that's where the failure was.
But is it a function of high-frequency trading, or is it a function of ETFs? More broadly? I mean,
it's funny.
Which are connected to some degree.
Yeah, I would argue that you wouldn't have had the explosion in ETFs if it wasn't for high-frequency trading, because some of them do wind the two together. In other words, if you're going to trade an ETF, you got to have the underlyings. There is an arbitrage there. That's a valuable pricing function that some people, some market makers do supply. You need that in the market. Someone has to do that. If no one's willing to do it, you won't have an ETF pricing. But that's not high-speed trading necessarily. When I look at high-frequency trading, I'm looking at the predatory stuff. I'm looking at the guys who are looking to take advantage of a latency situation. In other words, a dark pool has a pricing that's off, so he's going to take advantage of it. This
is the Michael Lewis Flash Boys thesis.
Yeah, that's considered latency arb. But there's other things out there. There's all sorts of predatory functions. If an institutional investor like Lee is out there and one of his traders are using a VWAP algo, say, volume weighted average price, it's often that they get picked off during the day because the broker that they're routing through may not necessarily be going to the best spot, which means that an HFT guy can pick that off. It's all intertwined. You see, it's not just high-frequency trading. It's the entire structure and design that failed.
Now, let me ask you this. Shouldn't a guy like Lee, who arguably sees through the noise, isn't necessarily focused on every last headline, who's a value guy, he should look at all this and say, this is great. I'm actually able to arbitrage these guys.
Well, you better do it quickly, because when those drops happen, 30%, keep your limit orders down, right? You want to have a 30% discount bids out there. But in the extent, yes, but for the most part, Lee's got to buy and sell stocks. And the predators are kind of circling him all day long. And it's not new, by the way.
It's not about Lee. I think we're talking about what's beneficial to the public as a whole.
Right, and in general, right, exactly. Look, even that, we're talking about institutions here. What about retail? What about the retail investor who had a stop-loss order on August 24th kick off on an ETF because it went market that morning as soon as the stop got activated, and it hunted down for a bid 30% below? How is that a market? How is GE trading down 20%? Why is GE over X amount of $1 billion market cap that morning? Did the GE IR exec, the investor relations, go into the CFO that morning and say, hey, guess what? We're down 20%. We just lost a ton of market.
I'm just playing devil's advocate here, but you're arguing that the market trades on fundamentals, and historically, at any one given time, you could say it never has.
But not to this effect. Not to a 1,000-point decline in a matter of minutes.
Something different out of total departure from historical patterns. And it makes no sense. The market isn't worth 50 or 100 S&P point difference in 5 minutes' time. You know it's wrong. And if something is wrong, you have to deal with it. And I think, and Joe, correct me if you disagree or I'm wrong, but a lot of the stuff gave rise after they eliminated the uptick rule. Okay? And the uptick rule served us well from 1900, I think, 38 to 2007.
I think partially that. I also think the obligations of a market maker, and some people had a problem with the old specialist system, but there was a function there where there was an affirmative and a negative obligation where markets were made, right? Where you don't have that now. You have prop traders who are making markets who have no customers.
Explain the uptick rule for those who are unfamiliar.
You can't short it on a down, right? So basically, there is a function of an uptick rule that still exists when a stock gets to a certain level. If it's down 10%, then you can't short on the bid. It's a modified uptick rule. It does exist. But otherwise, you can pretty much short a stock wherever you want.
Another fact, I mean, the Volcker rule, Dodd-Frank, the brokers have been discouraged from having risk assets. The commission structure has collapsed. So there's no incentive for the brokers to carry inventory.
Yeah, I
so
think
all these factors come together to really
In terms of the commission structure collapsing, I mean, for years people were saying, look, this opens it up so that the average investor isn't getting the short shrift. They don't have to pay and for every single stock that they trade along the way. That they you know, it's always been set up as the
some amount of
Wall
reduction
Street wins no
commissions.
matter what.
Well, I'd say the reduction in commission on balance is positive, but if you take all these factors together, Dodd-Frank, Volcker rule, discouraging carrying of risk inventory, I was a person against that. I mean, I was with Goldman Sachs for many, many years. They made a great deal of money in higher risk areas. We should have risk-based capital standards or require more capital, but to force them out of business that have been historically profitable is a mistake, okay? Because one of the strengths of whether it's Morgan Stanley, Goldman Sachs, what have you, is having diversified profit centers. And they forced them out of a lot of business that historically been very profitable. So the brokers aren't going to stand there making markets. They can't legally anymore because of all these rules. The commission structure does not reward them. In the old days, you know, they make a bid on the block because they had some commission to, you know.
Well, it was different. It was an ecosystem of trading. There was trading, there was research, there was investment banking, right?
But to address
that's what's
this,
been stripped.
To address this, what's the way that you can do it without unintended consequences? Because,
right.
like we say, you know, innovation, guys that do algorithms, they're a lot of them, they're amazing ways of making money for pensions and funds and things. So you don't want that to go away.
Listen,
what's the one thing you do that would prevent
well, I can tell you one thing. If the government comes in and puts a whole mess of regulations, then that'll screw it up
that's
as well.
what I mean.
We've done that already, and that's failed.
So what's the one thing that would work?
Free market, okay, there's two things, I think, actually. There's free market-based solutions. Look at IEX, which is a new venue, which is gaining a substantial amount of market share because it's a fair venue. You can go in there and feel like you're not going to get picked off, and there's going to be a dark pool who's going to be sniffing you. So one, make it a free market-based solution, but there are some tweaks that the regulators can do. In fact, they've just approved something called a wide tick, a tick size pilot, where basically they're going to increase the size of the tick, particularly small and mid caps, by saying, hey, listen, we need to build liquidity in the small to mid caps. They have recognized this. Regulators have recognized this, that there is a market design problem right now, that they failed when it came to Reg NMS, and now they're trying to tweak it and fix it along the way. So at least they've made one step. And we think that as they go through, they'll start to figure this thing out, but it's taken too much time. And unfortunately, events like May 6th of 2010, events like August 24th of 2015 will continue to occur and will continue to occur in more rapid terms and more volatile terms, and that's just the way it is, because that's the system that's been built.
And which I think explains in part why the public is leaving the market. They don't understand the game. Okay, they've taken $100 billion out of equities year to date. Where are they putting that money?
But hasn't that, again, and I'm playing devil's advocate, hasn't that always been the case? This goes to sort of the herd mentality, sheepish approach of the world that's gone on for years. When things have gone down, people have gotten scared and taken money out of the market.
You had it in 1987 with portfolio insurance, which is a variation of what was going on now. And you had that 22% drop. Everyone called for recession. Nothing ever happened. I think it's gotten worse. That's all. It's gotten worse. It's something they should deal with. They should focus on.
It's a feedback loop. Essentially, when on days like that, you get into these feedback loops, and it starts a cycle that you can't stop until either a circuit breaker hits or something like that. It's not a healthy market. The price discovery function broke down that day, and that's really bad.
And let me just say this. You know, I say the same thing on the upside. Look, you know, Pearl Bailey said she's been rich, has been poor, rich is better. I've been up markets and down markets. Up is better, but it's a problem on both sides of the market, not just on the downside.
Absolutely.
On both
this
sides.
morning, I mean, we're up 35, right? And but you're having liquidity issues already. It doesn't matter which side you're on. You're absolutely right.
Okay, we're going to leave the conversation there, Joe. Thank you.
My pleasure. Thanks.
And of course, Lee's going to stay with us for the rest of the show. We got to talk about buybacks, my friend, at some point.
My pleasure.
Okay.
When we come back this morning.